Well, hello everyone. Thank you for joining me. Today I'm going to be talking about ARC Resources. Before we start, I wanted to share this quick disclosure here. The information shared is aggregated from the public domain for educational purposes only. It's not intended or shall not be understood or interpreted as investment advice by any means. Please do your own due diligence and talk to a professional advisor regarding any investment strategies. So thank you so much for listening to this. And now we can talk a little bit about ARC Resources. So ARC, as you can see here, is essentially a Canadian company. It's an oil and gas company trading on the TSX. It's called ARC Resources. This company is market cap is $12.6 billion Canadian, and seems like their debt is about $1.26 billion, with entire enterprise value being about $13.8 billion Canadian. So their PE ratio is based on this RBC disclosure here is 5.3, and earnings per share is 3.89. So that's extremely healthy. And next time they're going to be reporting will be in November 2023. They also have a quarterly dividend they pay. It's about 3.29%. And you can see some timelines here, and that's the shares outstanding. So shares outstanding is essentially the stock price, which is 20.65 times this number. You end up with the market cap, plus you add the debt, so you end up with the enterprise value. So as you can see here, over the past 3 years, the company had really significant performance, up 207%. And in 1 year, it had a very interesting trend where it kind of reminds me a little bit of Tesla. Maybe, ARC has nothing to do with Tesla, but the stock chart is kind of intriguing, except Tesla was way more volatile. So you can see here, basically, stock went up to 20 and then really sold off to 15 and then recovered. Tesla, I think, did something similar, but it was down like 50% and then up 100%. Where here you can see kind of it has this breakout, probably trying to test the upper kind of limit of the trend. So if we compare the company to other companies, some of the comparables I found is so ARC is ARC Resources, CNQ, maybe Imperial Oil, Tourmaline, a huge producer in the Montney, Whitecap that recently acquired some assets in the Montney, and Kelt that operates in the Montney. So you can see kind of relative performance. They all done extremely well, and there is really cool correlation between all of those companies. So it's very noticeable here as you look. So if we look at the, let's say, 1 year relative performance between those companies, so ARC kind of sits in the middle. It's up roughly 18% in 1 year. But again, there was a significant journey kind of declining, almost 20%, and then having this nice recovery here. And, it probably some people in the community were kind of getting frustrated, but then when they look at the 6 months chart, it looks quite amazing. So that's great. But at the same time, Kelt is a smaller producer in the Montney, really outperformed, but ARC up by 31% here. So that's extremely positive, right? Where, let's say, like an Imperial Oil was up only like 2% over 6 months. But then over 1 year, Imperial have done extremely well, and ARC done well as well. So timeframes, I guess, are important. But today we're going to be talking about ARC in more detail and why people like the name, why they don't like the name, and just kind of do maybe a deeper dive, in that sense. So right now, what I'm going to do, we're going to share the quarterly results for ARC. So I think, and then we're going to actually watch their June update, investor update presentation afterwards, and really try to understand what they kind of were saying they're going to do back in June, what they actually reported in recently, so in August 2023, and really kind of go over the details of really trying to understand the name a little bit better, really kind of zoom in and see if they said what they're going to do and they actually executed. So as we so this is second quarter, essentially 2023, and as we dive into the highlights, you can right away see that they disclose here that they delivered second quarter 23 production at 343 1,630 BOEs per day. So BOE stands for barrel of oil equivalent. Those are not just barrels. The density changes because they produce a bunch of natural gas. They produce different types of crudes, different densities that they produce. Like you can have for example, like a butane or a propane or a hexane. So all of them will be treated slightly different. So then they kind of normalize it to barrel of oil equivalent. And we're going to be talking a little bit more in detail about what that partitioning is. But here you can see they're already telling us that 63% of natural gas and 33% crude oil and liquids. And you can start kind of understanding that close to 40% is oil for that company. And most of their production is associated with natural gas, which is methane and ethane, right? And you can see slight production increase over year over year. So they generated funds flow. They generated funds from operation of 561 million, which is 1.92 per share, and funds flow of 144 million, which is 0.24 per share. And they recognize cash flow from operating activities of 551 million. So a net income of 279 million. So those numbers are very positive, and they're going to be more looking into more detail about kind of in the tables of what was done. So you can see kind of on relative basis, and I think it's important kind of to look at those tables instead of reading the text and just trying to basically kind of let the numbers speak. Let the numbers speak, as I say. So financial results, net income. This is the 3 months. So 574, and for March 31, 2023, and this is their current essentially performance. So obviously, they've seen better performance. Kind of it looks like in the previous quarter. But then if you compare it to June 30th, 2022, where oil prices were extremely high, you saw much higher number, 762, almost $763 million in net income. And the reason why there were elevated prices, and maybe they didn't spend as much money. So that's kind of the only explanation that there is for this, because the oil prices improved since Q1. And so this, or maybe there was like a natural gas impact or some hedges. We're going to be taking a look, but and let management maybe explain, as we're going to be looking at their June presentation. But yeah, just something to kind of keep in mind. Net debt. So this is, and by the way, if you look at the capital expenditure program, so 487, 416, so they actually spend a little bit less than the previous quarter. So that's interesting, right? If you look at net debt, so 1.264 and 128 right now. So net debt kind of increased here a little bit, where longer term debt was 1.1 billion, 1.12 billion, and that also increased since it seems since March 31st, which was Q1 quarter, right? So 3 months ended. You can see on relative basis there is a little bit of an increase in net debt, but it's not a huge increase. So let's take a look at their kind of production. I promised to disclose kind of what they're producing in operational results. So let's see how they partition the various production. So they tell us here crude oil barrels per day and condensate barrels per day. And so condensate could be like a pentane, hexane, right? And so basically, if we look at Q1 towards Q2, really nice improvement in production here and is here as well, which maybe speaks to kind of their ability to generate nice cash flow, right? So crude and condensate in overall is 83 all combined, and natural gas MMCF per day. So this is big, right? MMCF per day. This is like BCF per day. If you divide by 1,000, so this is almost like 1.3 BCF a day. So this is a huge natural gas producer in the Montney, right? NGLs 45 natural gas liquids. So barrels per day, 45,000, barrels per day. So, and the total production 343, 630, if you combine all of those numbers together and kind of normalize to barrels of oil equivalent. Here you can see some average realized prices. So for crude oil, 88, condensate 93, very healthy price here for condensate, right? So this is for June 30th, 2023 for Q2. Natural gas 283. So this price was much higher in Q1, right? So and the Q2 2022 that was like $9, as you guys may recall from 2022. from last year, where those prices were highly elevated. And here, kind of on relative basis, you get 6 months ended, right, where you can really see the big delta in 750 and 434 in natural gas prices. So natural gas liquids, 28 previous quarter, 20 this quarter, and 34 last year. And average realized prices was about $36 here. So now they're talking about netbacks, and so the netback is, a little bit less than previous quarter, mainly because of the numbers that we saw, like condensate. Basically, realized prices was much higher. Crude oil was much higher. Natural gas liquids was a little higher, and so as those prices improve, you're going to be seeing more probably prices that were associated with the previous quarter for ending in March 31st, 2023. And yeah, so that's kind of exciting. So let's see their guidance outlook for 2023. So what they show here is that crude oil per day, right? So year to date, this is their current production, and this is kind of the range. So they're going to be looking at increasing production for crude oil. Condensate, same story. So they're looking at guidance for increasing production here a little bit, going from 73. Yeah, so again, crude oil condensate overall production is about to increase by, it seems like, about 4,000 barrels a day or so on average. Natural gas in BCF, slight increase in natural gas production as a guidance to 2023. NGL, so we can see a common theme here where the production is continuing to slightly increase in that range versus what was reported year to date on the actuals. You can see 6, 4, 4, 1, 4, 4, and 3 on total. So 3% overall increase in production, going from 341 right now year to date. I think they reported 343 for the quarter, and 350 to 355,000 total BOEs per day. You can see expenses, very small expenses, right? Operating expenses, transportation expenses. And so that looks pretty good. Let's see some more kind of visuals here. Okay, something I really wanted to share, which when I saw this table, I was a little bit kind of excited about. So here I will show you, yeah, so free funds flow. Yeah, so they basically, and I think it's important to take note of that free funds flow. So this is essentially cash flow. So in this way, somebody could calculate basically their yield, right? So this is in millions. We said that their enterprise value is roughly 13.86 billion, and the free funds flow 3 months ended in June 30th was 144 million. I'll take note of that. And the previous was 230, and the previous year was 677. So if you start kind of adding those numbers, you can see that. So this is fascinating, right? So 6 months ended, and you essentially kind of, because we have four quarters, right? And here we're kind of halfway. You can start doing sensitivities to the prices and say, okay, well, what is that number that they're going to be yielding maybe on annual basis, right? So if we take a quick calculator here and we assume that what was happening last year was kind of continued, and they after the 6 months, the free funds flow, free cash flow was $1 billion. So let's say 2 over their current enterprise value, which is 13.8. So you get about 14.5% free cash flow yield. So that sounds very healthy. Up until now, they have 374 million. So if you take, if everything goes kind of business as usual, if oil prices just remain in the same range like they were, and natural gas prices remain in the same range like they were in the past 2 quarters, then you do essentially 375 times 2, so you get 750, and divided by 13 billion, right? 13.86, let's say. So you get about 5% or so free cash flow yield. But oil prices improving now. Natural gas prices seems to be like improving. So maybe their free cash flow yield is somewhere in the middle there. So yeah, it's important to be mindful of that. Now, capital expenditures here also were significantly different if we kind of look in this line. So The amount spent, let's say, up until 3 months in June for this year was 416, where June like last year's was 350. So there was a little bit more kind of capital expenditures, and funds from operations also changed, right, significantly. So that all of those things kind of they come into account when it comes to calculating the free funds flow or free cash flow yield. And so I think it's important to be mindful of the fact that maybe they could be yielding as high as like 5%, or maybe they could be yielding as high as 15%, or maybe somewhere in between. So this is something important, and this is really a function of all the prices, natural gas prices, condensate prices, all those kind of unique component within the hydrocarbon chain that they've been disclosing to us of what kind of composition they're producing. And obviously, being a 63% natural gas producer, that's essentially like, and I think it was like over a billion, over 1 BCF, 1.2 BCF or so of natural gas production, natural gas liquids production. This is becoming like a significant LNG producer, right? So this is something that really important to be mindful of these numbers, and kind of propagate this as you kind of assess the company. Obviously, don't take my word for it or their word for it. Just to kind of go to their website, ARC Resources, and this document is from the Q2 earnings, and it's like forward-looking information, and obviously there's lots of disclosures here, so one must be mindful that to verify. And if you're not sure about something, just give them a call or message their department and kind of get more information. And please, if you have any comments, if you see anything I said that was wrong, then please comment and make sure we verify this. And so again, if you look at 2023 and kind of historic production, let's take a look what happened here on the historically, right? So crude oil barrels per day, condensate barrels per day, you can see significant kind of numbers here. I mean, if you combine the condensate, so penta and hexanes, like that kind of C5, C6, C7 range, right? So you get like 81,000 barrels per day. 2022 it was 86. So that was significant jump from 2021. 2020 to only 29,000 barrels a day. 2019, 27. So this company is really in kind of it doesn't look like, if you were to look at 2022, 2023 timeframes, but if you look historically, there is significant growth kind of, at least when it comes to crude oil and condensate growth. Let's look at the natural gas. So this is MMCF per day, so 1277. So let's see, again, it correlates, right? So they must have developed some kind of assets or grew their production with capital investment during the years where we had the significant downturn, especially during COVID. So really important to kind of consider. And again, we could tell that all of those things correlate, or there was like a field growth or something associated with growth or acquisition, where it wasn't just like tackling one isolated field. It was basically everything, because you can see the same kind of correlative behavior even in the NGLs. So total oil production obviously going from 139,000 from 2019, and I don't want to say triple, but increases significantly, more than double, right? So maybe like, I don't know, 2.5 times, 341,000 barrels a day. So that's significant. Okay, so again, we're going to revisit the net debt. What happened with net debt? And so net debt increased, right? So net debt increased, and this really tells you with the production increasing. So in oil production and overall production here, well, what happened here? Why is your debt increasing? Well, essentially, it seems like they used some debt here to increase production. So one could correlate kind of their net debt performance towards the production increase and see whether good decisions were made. I think amazing decisions were made, because you can clearly see the trend here. They go from 894 million in debt, net debt, to 693. Then it kind of increases significantly, but now again they're reducing year over year. So that's extremely encouraging if you ARC, right? So on the quarterly results, you can see kind of in more detail about net income loss per share. So if it kind of so, and then the per share diluted, so you can see basically what they were able to generate. So they had very positive quarters here. Obviously, this quarter was a little bit down on a relative basis. And cash flow from operating activities, again, very similar to the previous quarter, I guess, when it comes to cash flow from operating activities, and also per share diluted. Funds from operation were, so this number is a little bit down here. Same with the per share diluted, you can see on the right side of the curve. So small decline here, but nevertheless, the production increase is significant. So maybe this is kind of investment towards the kind of the cycle as the cycle continue to perform here. And average daily production, you can see average daily production Q3 2021. You can see daily production BOEs per day. It kind of looks like it's flat. So that's interesting because if you think about the table that they disclosed here, from year to year, you have total production in BOEs, which looks like this, right? So 341,000, 139,000. And at the same time, average daily production, you have, daily production in 1,000 per share. So you have a number here. So maybe there was an exercise. I don't actually know how to understand this graph exactly. I'm going to have to think about this a little bit more. Let's see if I'm missing something. So 2019, 2020, 2021, 2023 highlights. Okay, so this is the oil production. So 341, this is 139. And this is average daily production 340. So maybe there were some transactions. I don't know. It's maybe something to clarify. So you guys let me know if you see something that maybe I'm doesn't make sense here or makes sense to you maybe more. So, but nevertheless, that's what they report. They report 343,000 BOEs per day. And here we can see the year-to-date actuals, which is closer to 341. And so they're basically guiding 350 to 355 at 2023 guidance. And you can see the relative partitioning as we talked, as we shared. And then the expenses are expected to continue being the same way when it comes to operating activities. Transportation looks like it's going to increase just a little bit. General G&A supposed to general and administrative expense, which is G&A, supposed to decline a little bit here. And interest and financing looks like it could be in that range what they have now. Current income tax expense is percent of funds from operation, so that will be a little bit higher here. And capital expenditures, they're going to spend way more money. So really fascinating, right? I think it's an important number here to consider. So year to date 2023 actual spend 0.9, and on the guidance of 2023 about to spend a little bit more, 1.8 to 1.9 billion. Now this exhibit production guidance, and it looks like they provide a little bit sensitivity here on the total. So this light blue is essentially year-to-date actual. So that's where they're at, 343 or so, or 341,000. And on the guidance side, they're going to go into 350, 355, and they're going to spend a little bit more as a share before, which suggests, increasing production, crude oil and condensate. Again, all of the parameters we talked about, all of them are about to increase a little bit more here. And natural gas liquids, barrels per day, 47,000, going into like mid 50,000 range. So this company is planning on growing here a little bit. So when it comes to their production capabilities, expense guidance. So expense guidance so far, you can see from operating, they're basically in the mid range on the operating dollars per BOE per flowing, I guess. Transportation is going to be increasing here a little bit. G&A going to be decreasing like we shared. Interest and financing probably going to be increasing here a little bit. Okay, so I think we cover most of it. And I think right now what could be a good idea is to go to their June presentation and really listen to what management has to say and really understand those numbers that I shared a little bit in more detail. So let's kind of go and share that right now. So right here. All right.
All right. Let's get started. I just want to, for those of you that don't know me, my name is Dale Luco, Manager of Capital Markets here at ARC
This
Resources.
is from June 2023.
Quickly, I just want to
investor update
sincerely
from
thank
ARC
everyone for
Resources.
attending, both in the room, in person,
And they're going to be clarifying some of the
and
information
on the
we've seen.
webcast.
Maybe we
and also thank everyone back at ARC. There was a lot of people that dedicated a lot of time and resources into getting this pulled together, and I think we did it. I'm just going to quickly walk through the agenda and introduce the leadership team that's presenting today. In my opinion, these are most effective when there's something incremental and informative and done efficiently. And I think we sort of achieved that today. So I'm excited to get this underway. Senior leadership team presenting today to my right, Terry Anderson, President and CEO, Chris Bibby, Chief Financial Officer, Laura Conrad, Chief Development Officer, Armin Jahangiri, Chief Operating Officer, Ryan Barrett, Senior Vice President Marketing, and also joining us, Lisa Olson, Senior Vice President People and Corporate, and also from our Board of Directors, Carol Banducci. So with that, I will turn it over to Terry Anderson, who will talk about our long-term plan and then give a corporate overview.
Perfect. Thanks, Dale. So good afternoon, everyone, and welcome to ARC's Investor Update. Thank you very much for being here. We appreciate you taking the time out of your busy schedule to come and sit and chat with us for a bit. We're excited to present to you our strategic direction and our 5-year plan going forward here. But before we get into those details, I want to just step back for a minute and talk a little bit about who ARC is and some of the decisions we've made over the last couple years that really have set the company up for success going forward here. So this corporate profile slide is for people that are less familiar with ARC. ARC has been in business coming on 28 years now, and we've always been focused on long-term profitability. We've paid a dividend since inception, and that cumulative paid is $8 billion. So that equates to greater than $30 per share, which is pretty significant. And our market cap today is around $10 billion. ARC is the largest Montney producer with current production of 350,000 BOE a day. We are also the largest condensate producer in Canada, and we're the third largest natural gas producer with production of 1.3 BCF a day. 100% of our production comes from the Montney play. So yes, we are a pure play Montney producer for a reason, because the Montney is one of the most profitable and one of the largest resource plays in North America. And we know the Montney better than anyone. I would say we are experts at the Montney, and that's a strategic advantage. So how did we get to this scale? Well, we were leaders over 10 years ago to have a vision to transition away from the old conventional assets to the new world-class Montney resource play. We drilled the first horizontal well back in 2005 in the Montney and multi-stage fracked that. And this comment's going to date me, but I was part of the technical team that actually drilled and completed that well a short 18 years ago. But that really kicked off the Montney boom. And then we started acquiring Montney, large swaths of Montney in the sweet spots. And then 2 years ago, the final piece of the puzzle was our Caqua acquisition. And this created these large concentrated assets that we have today with over greater than 1 million acres of high quality Montney resource. So the map on the right is a beautiful picture of efficiency. And Chris laughs at me when I talk about this slide because I think this is the most amazing slide there is. Maybe it's something to do with the engineer in me, but it's because it speaks to this pursuit of efficiency and profitability. That's what I see when I look at this slide. And to help context that, if you think of, to put it into perspective, in 2014, we produced 110,000 BOE a day from 5,700 well bores. And our production mix was 60% gas and 40% liquids. Today, our production is 350,000 BOE a day from only 1,700 well bores. and our production mix is still that 60% gas, 40% liquids.
So that really explains it.
That is what I called improved efficiency and why I love this slide so much. Not sure, Chris is probably still laughing at it, but it's my slide, I like it. So we've taken bold actions in the last 2 years to really set the ARC up for the significant inflection point in our free cash flow per share over the next 5 years. And we're going to show you that because it is significant. The business combination was transformational for us. And the benefits of that increased scale has positioned the company to control our destiny, pursue new business opportunities like LNG, and deliver significant value to shareholders for decades to come. I want to point out that dividend remains a key component for our shareholder return proposition. And we have already increased the dividend to above pre-COVID levels. And so there's some of the points you see on this slide really sets that solid foundation for the next 5 years that we'll discuss today. ARC has a proven track record of consistently delivering strong results across all aspects of our business. And we do it quarter over quarter, decade over decade, it's supposed to be year over year, then decade over decade. But it's easier said than done to consistently deliver strong results in this industry. It takes a lot of work and a lot of discipline. So what is that secret sauce? Well, this is what differentiates ARC. On this slide, there's a lot of attributes here, but it's not one of these attributes in particular that makes the difference. It's the combination of all of them. So world-class assets with scale. You'll hear Lara talk about the depth of our inventory. This culture of discipline, which is about managing risk while creating value. Operational excellence, well, that is the hallmark of ARC's success. And you'll hear Armin talk more about some of our technical excellence. And always having financial strength. It's important so that you can manage through the cycles, but be able to act on these opportunities like we did 2 years ago. I would say there are very few companies that have all these attributes and that can consistently deliver strong results year over year, but ARC can do that. So that's a quick look in the rear view mirror. Now let's look forward to what we've been waiting for here. So our 5-year plan delivers significant shareholder value. This is a very disciplined plan that balances capital allocation to maximize returns to shareholders today, but in the future also. The plan on this page, you'll see, is a 3-year cadence between development projects. So the first phase of Attachie comes on full stream in 2025, and you can see on the top graph the dark blue bump. And then on the bottom graph, you can see the corresponding bump in free cash flow. Then 3 years later, in 2028, the second phase of Attachie comes on, and that's the gray bump in the production and the corresponding huge bump in free cash flow. So the free cash flow per share triples from about $1.60 in 2024 to $4.80 in 2028, which is a CAGR of 24%, which is a result of that growth by investing in Attachie and growing that free cash flow, along with reducing our share count. So we are on the cusp of a significant inflection point in our free cash flow per share growth over the next 5 years. Investors would not appreciate this yet because we have not shown you a 5-year plan, and now we are today. So for context, the cumulative free cash flow by 2028 equates to $8 billion, or 80% of our current market cap. $8 billion. That's a lot of cash flow that comes back to the shareholders. The plan delivers significant value with a 20% ROACE.
Just over 13.
The numbers on this page look great to me. They're quite staggering. Hell, this might be my new favorite slide, Chris. But now, The hard part is executing and delivering on this. But it's also the exciting part because operational excellence, that's our forte at ARC. We do this, and we've done it many times. We will deliver on this successfully. And the team will provide more details on this 5-year plan going forward here. As I mentioned, we have greater than 1 million acres of high-quality Montney land. ARC's Montney assets are some of the best from a quality and from a scale perspective. And ARC has always been praised for having great Montney assets. So our production mix, as I mentioned today, is 60% gas, 40% liquids. And that percentage stays the same, it's constant over the 5-year plan that you see here today. And we are focused, and that's because we're focused on developing the Attachie liquids. Our asset portfolio that this graph shows has the capability to easily grow to 500,000 BOE a day and remain flat for decades. Like, that's impressive for the size of the company we are. So we are very fortunate to be in a position to not have to worry about inventory duration or asset quality. That probably will answer the M&A question if anyone has one later. We've always have a balanced approach to our natural gas marketing across North America, and now we're extending that diversification globally, targeting up to 25% of our production to have exposure to international pricing. Our decades of world-class Montney inventory allows us to pursue global LNG opportunities. Frankly, the world needs more Canadian natural gas energy to address energy security, affordability, reliability, and to lower global emissions. We need to do more as a country. This is an important part of our business diversification strategy to enhance revenue per BOE. And this is definitely a differentiator in ARC's value proposition to you. So why invest in ARC? Well, here's 4 key buckets that I just want to touch on. So I talked about being disciplined. It's about disciplined growth is the first one. By investing in Attachie development and reducing the share count, our 5-year plan triples free cash flow per share, as I mentioned. Second, the commitment to shareholder return. Today, our long-term debt is around $1 billion, and that's where we want it to be. Therefore, we plan to return all free cash flow to shareholders through the dividend and share buybacks. We'll continue to pursue a balanced capital allocation strategy to ensure strong shareholder returns today while investing in our business to grow shareholder returns tomorrow. World-class assets. I talked about the massive scale of greater than 1 million acres of high-quality Montney, which provides decades of inventory runway. Over a decade ago, we developed a strategy to diversify our natural gas marketing across North America at a much lower cost structure than today, which is a strategic advantage for us. And then the margin expansion. Well, one of the benefits of our scale is our ability to expand margins with global market diversification. The significant scale of our current infrastructure network that we'll talk more about allows for lower reinvestment ratio going forward, hence more returns to the shareholder. Now, let's get into the details of this compelling investment case, and I'll turn it over to Chris to walk through our capital allocation strategy to start with.
Thanks, Terry, and welcome everyone. It's very good to see everyone here today, and we're looking forward to it. So, as Terry mentioned, I'm going to walk us through our capital allocation, how we're thinking about it, and where we want to go, and some of the outcomes of it. Really, if you think of it this way, I get to go through my favorite slides. Now, Terry went through his, now it's my turn. It's really how we put the deck together. We all just put our favorite slides in. Okay, as ARC's entering its 28th year of operations and of business, we are very proud of our track record of profitability. You can see on the chart, we've averaged about 13% return on invested capital over that period. And you can see on the right side that it's going to be higher going forward. I'll just touch a little bit on shortly after the financial crisis
must
in
be double
08,
digits,
09,
must be.
10, you heard Terry start talking about how we were looking at our profitability and it was a little lower than we wanted to see it. And that was where the opportunity was to then turn and pivot and focus on the Montney. You can see it took a few years, we had COVID, we had all kinds of a price war on both the oil side and then also on the gas side. So it took some time, but we got there and now we've made the corner and you can see the increased returns that we have experienced recently and are going to going forward. So it's a great investment opportunity from us. Terry hinted at this as well. And so what we're talking about here now is just shifting gears a little bit and how are we going to get the optimal returns to shareholders? And it comes from capital intensity. So you can see as we were building out the Montney over the past decade, capital intensity was a bit higher, elevated, obviously as we're building out facilities, achieving scale, and developing our assets and facilities. Now we've turned the corner again, and you can see from basically 20 on, roughly 50% of our cash flow will go into the ground, leaving a tremendous amount of free cash flow for those optimal returns that we are talking about. We've got the scale, we've got the decades of inventory, and we've got the business processes in place to develop this going forward, and that's what's going to allow for the superior returns. We like the 5-year outlook so much that we thought we'd give you another version of the slide. So on this one, just want to dig in just a little bit on a few things on it. So I do want to remind everyone, and Terry mentioned this as well, this is one scenario. So something that ARC always does is we plan multiple scenarios and then we go ahead and execute. We're moving ahead with Attachie Phase I. It'll be on stream fully in 2025. And then in this scenario, we have Attachie 2 coming on in 2028. The organization is continuing to prepare, and so we can move things around, but we don't have to make that decision today. And really what that'll give us is some flexibility. It'll depend on the commodity market at the time, as well as a combination of us focusing on this balanced capital allocation approach. You can see capital ranges roughly $1.7 to $2 billion per year over that time period. Fluctuates obviously as we are investing in growing the production. The production growth on the bottom left, you can see is quite significant. And as always, ARC always, we always plan for sensitivities and what happens if we go into a low price environment. You can see on the bottom right, it's funded through a very low price environment should we choose to keep going. Obviously at the higher prices, it just generates that much more free cash flow. Free funds flow per share. So this is a really powerful slide, and I just want to zoom in a little bit. The growth in this is a combination of effects. So it's both comes from growing the profits of our business by investing in our base assets, Attachie Phase I, Attachie Phase II, as well as the retiring shares. So when we look out at current valuations, we would continue to retire a tremendous amount of shares, which is really compounding this growth. You heard Terry mention, growing from $2 roughly this year, well up above $4 and approaching $5 in 2028 on a flat deck. So we're not messing around with price to create this. So we're very confident this will be base underlying growth. Now the fun part is really what are we going to do with this free funds flow? So the free funds flow allocation that we're looking at over the next several years, you can see is excess free funds flow available. So we're going to hold our base dividend payout ratio in that 15% range, and that will allow us with a tremendous amount of excess, where currently we are retiring a lot of shares given the valuation disconnect relative to how we view intrinsic value. This part's a fun slide. It's a bit illustrative, which it always has to be when you're forecasting forward quite a bit. What we're trying to show here is really just the power of the combining effects of investing at a reasonable pace, retiring shares, and paying out our dividend. You can see the compounding effects on the dividend going up and to the right, holding that payout ratio in that 15% range. And then the line coming down is our share count. So as you know, we issued about 350 million shares when we acquired 7 Generations in 21. And you can see it coming down to the right, essentially getting back down to our pre-business combination levels by the end of this period. And the balance sheet stays the same. So it's really just the compounding effects of how we are investing in our business on that balanced capital allocation. I'm going to end here before I hand it off, and just to remind everything. So our principles haven't changed. We're a balance sheet first organization. The balance sheet is exactly where we want it. We've got our $1 billion of long-term debt outstanding in our investment grade notes at sub 3%. And we think that's the appropriate amount of leverage on this balance sheet. We do have tremendous excess liquidity and access to capital via our banking group, but that's really, it's flexibility for us is what it is. Balance sheet first, the balance sheet's exactly where we want it, which allows us to essentially pay out all free funds flow via the dividend and via share buybacks, which is really what the compelling case for this is going to be. And with that, I'm going to hand it over to Lara and Armin to walk through what you're really here for, and that's all the exciting development plans we have.
Yeah, so it's about 8-10%, close to 10% of enterprise value
And
on debt.
good afternoon, everyone. Armin and I have the pleasure of walking you through ARC's asset base. As you've already heard from Terry and Chris, we're very proud of our asset base, so kind of fun to get to walk through it today. We are incredibly well positioned as all of our production, as Terry said, comes from the Montney, and it truly is an amazing resource. We love the Montney for how efficient it is. You know, with over 300 feet of thickness in the Montney, we're able to go in and do multi-layer development and have significant resource per section. And this really does create amazing development opportunities for us. Not only do we love the Montney itself, but we're also very proud of the position we have in the Montney. Our lands are predominantly in the higher pressured areas of the Montney, so most are in the overpressured, and that gives us high deliverability. And we also have contiguous lands, which really does allow for that efficiency that Terry spoke to. And with that, we have decades of top tier, low cost inventory, which delivers some of the best economics in the basin. We realized the quality of the Montney very early on, and that is what has positioned ARC so well. We were able to enter in at low cost. When you look at from 2000 to 2010, we were accumulating our asset base. As Terry mentioned, yeah, he has the bragging rights on drilling that first horizontal well in the Montney. And what that did was not only get bragging rights, but also allow us to go in and really capture a lot of mineral rights across the Montney, identify some of the highest value areas in the play. And by being such an early mover, that's how we got such a great consolidated, efficient position in some of those best spots. We've been in a development mode effectively since 2010, organically growing ARC's Montney production from basically zero to the 160,000 BOEs a day in a decade. We built this cash flow base through sustainable long-term development. And what we mean by that is we built our own facilities, duly connecting them where possible. We always make sure we have at least 10 years of inventory before we invest in infrastructure so that we know we have that sustainable investment and can maximize our returns. And then, of course, we made the counter-cyclical acquisition of 7 Generations in 2021,
That's right.
which
2021,
effectively doubled
7
our production base.
That's right. That's why
when we come to Attachie Phase I and bring that on stream, it will be our 8th major facility project that we've constructed in the Montney.
So all those numbers we talked about.
I'll hand over to Armin now to speak in more detail about our infrastructure and operational performance.
You can see it in the jump there. By the way, last year in 6 months, we generated over $1 billion in free
as Terry mentioned, we are extremely proud of our operational excellence. So I want to spend the next 3 slides to show how, as ARC, we continue to deliver best-in-class and low-cost production. Let's just start by discussing the benefits of ARC's owned and operated infrastructure. As you can see on this map, we own a large network of plants across our asset base. This network gives ARC the ability to handle about 1.5 BCF a day of natural gas and 135,000 barrels of condensate or liquid handling capacity. We see multiple benefits from owning this infrastructure. The first benefit is the operational flexibility. As an operator of these facilities, we are able to optimize our production based on market conditions, which is a work that happens pretty much frequently between our operations and marketing teams. And that work over the years has resulted in generating millions of dollars of value for our shareholders. Owning the infrastructure also gives us the opportunity to remain very nimble and react very quickly to the operational challenges. An example of that would be the wildfire situation in Alberta and BC, in which we were able to basically divert our production and minimize that risk on ARC's operations. And finally, in terms of operating cost, we estimate that ARC is saving about $300 million per year simply by avoiding paying third-party processing fees. We are also very focused on reducing our capital cost. There are 3 things that we do to improve our cost structure. Number 1 is getting the lowest cost for our material and services. We have a dedicated procurement team that are very effective in leveraging ARC's size and scale and our level-loaded activity to secure best possible pricing for us. Design optimization is the second and perhaps the most effective way of improving capital efficiency. We have technical teams who are dedicated in optimizing our drilling completions and facilities design, and they are responsible to find that optimal capital efficiency, which is the right balance between capital and production. And we will share a few of those examples as we go through the presentation. And finally, we put a lot of focus on delivering the most efficient execution in the field. Our teams have specific KPIs that they use to measure and benchmark ARC's performance against our peers. This slide shows a couple of metrics that our completion and drilling teams use for benchmarking, for their benchmarking exercise. In terms of completions, as you can see, the top 2 graphs, we outperform on our peers in terms of tonnage of sand pumped per day, as well as the wellbore length that we complete every day. And on the drilling front, our rigs continue to outperform our peers in terms of meters drilled per day. This next slide is the same exact drilling and completions metrics as we saw on the previous slide, but this time is for Caqua Operations. Again, as you can see here, the comparison to our peers' data show that ARC is delivering top quartile performance, both on completions and drilling front. The 8 rigs that we have that has been drilling for ARC in Caqua since 2021 are delivering performances that is exceeding every other peer company that is operating in the region. With that, let's pass it back to Laura.
So Armin just spoke to ARC's, sorry, with a little dance here, ARC's strong track record. Looking forward, we also have a strong position moving forward, and that's really to do with the substantial inventory that we have ahead of us. Terry already spoke to how proud he is of this inventory and how we really do feel this sets us apart. In the light blue are the wells that are booked as reserve locations, verified by our third-party independent qualified reserves evaluator. And then in the dark blue are the inventory locations that are additional, and those will be booked as we develop the assets. When you look at it for each of our producing assets at Caqua, Dawson, Ante Creek, and Sunrise, we have anywhere from 10 to 20 years of inventory to maintain those assets at their current production levels. Additional to this, we have significant inventory at Attachie, at Septimus, and at Sundown that will provide growth options for our future. Caqua is a high-quality asset with inventory to sustain the current production rate for 15 years. I think sometimes the scale of Caqua has been underestimated or not fully recognized. When you think about it, we're producing 180,000 BOEs a day right now, and we've only developed 45% of the land base. With that other 55% that's left to be developed, we can sustain this asset at its current run rate for an additional 15 years. This is longer than I think we had originally estimated too, and that's because we've now included the lands to the west of the Cut Bank plant. This is really consistent with how ARC performs and what our track record is. Once we get our hands on an asset, we like to spend the time to optimize it. We now have the full development plan for those lands west of the Cut Bank plant, and with that, we've got the infrastructure plan. We know how to manage this asset and how to develop it, and we've added those locations into our long-term plan. The other benefit of having such a great asset like Caqua, where you have this large contiguous land base, is in that 45% of land that we have developed, we have about 750 producing wells. And from that, not only do we get great cash flows, those wells I know are often featured on the highest productivity wells in Alberta on the top Montney well reports. And we really see the strength of their deliverability through those. But we also get value from these wells as far as the learnings that they deliver. We integrate that into how to best optimize our development go forward, and then we have the ability to predict our performance. So I know a couple people spoke to some of their favorite slides. I think I'm kind of getting into one of mine. And it's really because I get to geek out a little bit about some of the great work that the team has underway. I'm showing 2 recent examples here of where we've improved performance, and we're going to keep applying these performance improvements to the next phases of development. On the left-hand chart are the results of widening the interwell spacing from 135 meters to 175 meters. Anyone familiar with the ARC story knows that this is something we undertook quite some time ago, basically upon acquisition of 7 generations. It's a design progression that we evaluated in that acquisition and we implemented right away. And we've now seen very strong results from it. Productivity has increased by 18%. And as a result, we need less wells to sustain our production and therefore have lowered the sustaining capital for Caqua. More recently, the Caqua asset team identified the opportunity to develop both the upper and the middle Montney as a single layer development. We're aware that the wells talk to each other and they're not really fully separate layers. And what we were seeing is that we had better drilling performance and better frac initiation when we landed the wells in the middle Montney. So what I'm showing you here is a middle Montney only example. Not only did we know that we had better operational efficiencies, and as I said, better completion initiations, but we also had diagnostic work that indicated that the frac geometry that was created in the middle Montney accessed the full reservoir and effectively was draining both the upper and the lower Montney. So this is now proved out. We have a 7% increase in production from drilling exactly the same number of wells, but landing them all in that middle Montney. And on top of that, we've seen 10% improvement in our costs because we're able to drill the wells faster and initiate the fracs better. So with that, the resulting capital efficiency has been improved by 20%. Super pleased with the results of the team. So I'm going to call this one as my favorite slide to get to brag up their results. Now moving over to ARC's Northeast BC assets, we come to Dawson, which I always love to speak about because it really is such an amazing asset. As both Armin and I showed earlier, we've had 4 phases of infrastructure development at Dawson and have processing capacity of 300 million a day that's fully owned and operated by ARC. This high quality reservoir has produced over 1 TCF of gas to date. It achieved that milestone in 2022. And despite this remarkable achievement, we only have developed about 1/3 of the land base. So again, similar to Caqua, we have a huge amount of inventory ahead of us. We've had recent base well performance exceed our expectations, which has allowed us to reduce our capital budget for 2023. And we also have very strong half-cycle economics. The payouts at Dawson are right around a year. And with that, we end up with an excellent business that delivers free funds flow at a very low reinvestment rate of just 38%. Sunrise is ARC's producing dry gas asset that's interconnected to Coastal GasLink pipeline, ready to take gas to Canada's west coast for LNG. This is a highly efficient land base also, and that's really to do with the stacked development layers at Sunrise. We only have 35 sections of land at Sunrise, and yet we can hold production flat at 365 million a day for 20 years. As we often speak to, Sunrise is an incredibly low-cost asset. The F&D for Sunrise is about 50 cents per MCF. The OPEX is about 25%, or 25 cents, per MCF. And the transport costs are 35 cents. So all in $1.10 per MCF. Of course, on top of this, we'd have to look at royalties, but royalties are price sensitive in BC. So you can really see how wonderfully resilient Sunrise is. The Sunrise facility is also fully electrified, powered off the BC grid, thereby providing low emissions production. So with the long life, the low cost, and the low emissions of Sunrise, it really does make it ideal as a West Coast LNG supply. And then on similar geological strike as Sunrise, we have Septimus and Sundown, both of which will provide strong gas development opportunities for our future. We have the full development plan in place at Septimus. I know this isn't one we've talked about a lot, but that asset is ready to go. And so we can sanction that when we decide the timing is right from a capital allocation perspective. We have 17 TCF of gas in place at Septimus and Sundown combined. And again, the resource is well positioned to feed LNG as we can develop these assets, similar to Sunrise with that low cost, low emissions profile. Right, our aim here is to produce about a BCF a day of gas for 15 years, really providing that longevity for backing long-term supply contracts. And Ryan's going to speak to more on to our philosophy on those supply contracts in a few minutes. So with that, I'm going to jump into Attachie, which of course is what we're all really excited about. We've now gone forward with sanctioning our first phase of development, and as Armin will talk to in a moment, activity is well underway. Attachie really is ready for that large-scale multi-layer development. We have over 1,500 future drilling locations identified that we're very excited to be moving forward with. ARC's lands at Attachie cover over 300 net sections, or 200,000 contiguous net acres of 100% owned land. This consolidated land base allows us to do what we do best from development and operational efficiencies. We have our full field development plan in place, which includes the wells, the drill pads, the facilities, the pipelines, and the water infrastructure. Having such a large block of land really does allow us to plan out our development in a highly efficient manner. We'll also have dual connectivity for ARC's gas, which allows operational flexibility. And I think the excitement we have internally, you know, it was almost palpable in the office as we sanctioned Attachie. I think that excitement really comes from the fact that this is just the first phase of development at Attachie. We have plans underway for an additional 4 phases of development, given the scale of this asset. With that, I'll pass back to Armin to talk a bit more about the facility design.
Thanks, Laura. So as Laura mentioned, the work has already started in the field. I wanted to spend a few minutes and provide a high-level overview of the execution plan for this project. So as you know, we have estimated to spend about $740 million of capital to build all the associated infrastructure and to drill and complete the initial wells that is needed or required to fill the plant. As part of this overarching phase 1 project, we will be building a 90 million a day gas processing facility, as well as executing approximately 200 kilometers of gathering infrastructure and pipeline that gathers our production in the field and also allows us to flow to the sales points. We are also building a water recycling facility that will provide water for our frac operations. And in addition to that, we are building a network of transmission and distribution lines, power lines, that will fully electrify Attachie. So a very large scale project. The plan is to execute all of these projects in 18 months, and with the expectation to reach full production capacity early 2025. It is important to highlight that $65 million of that $740 million is expected to be invested on infrastructure that will support subsequent phases of Attachie. It is also important to note that we've been working very closely with First Nations over the last 5 years to optimize the plan and minimize surface disturbance. And because of that collaboration, we've been in a position to sanction this project today. So a lot of work has gone into planning this project, and we believe we are set up to deliver one of the most efficient projects that ARC has to deliver.
So just finishing off on Attachie, when we look at it, not only do we have a facility and infrastructure plan that's ready to go and completely underway, but we're also equally convicted in the well performance that we have at Attachie. Rarely do we end up having over 2 years of production data from a development pad prior to sanctioning a project. For Attachie, we have exactly that, and it really is a bit of an engineer's dream to have that much data to build your long-term plans off of. You can see here the overlay of our type curves to that data, as well as an overlay of the Caqua type curve. All data has been normalized to 2,700 meters horizontal well length. You can see the similarity in the deliverability of the two assets, Caqua and Attachie. Having said that, the subsurface characteristics of these two reservoirs really do differ quite a bit. The pressure grading at Caqua ranges from 10 to 14 kPa per meter, whereas at Attachie it's slightly higher, ranging from 12 to 16 kPa per meter. The true vertical depth, or TVD, of Caqua is between 2,600 and 3,500 meters, whereas at Attachie, we're actually just under 2,000 meters. The net pay and porosity of these two reservoirs are fairly similar, but the permeability at Caqua is really much better than at Attachie. So although Attachie and Caqua are comparable when you look at the condensate gas ratios, or CGRs, the different subsurface characteristics of the two reservoirs require us to employ different development designs to capture the resource efficiently. We're spacing our wells at Caqua at 175 meters, as I spoke to earlier, whereas at Attachie, the interwell spacing of our wells will be 300 meters. With that wider interwell spacing, we'll have a higher tonnage intensity at Attachie, allowing us to access the reservoir. The resultant reserves per well and the F&Ds are actually going to be quite similar between these two investments. So overall, we have a really strong liquids play at Attachie with a CGR relationship that's very similar to that at Caqua. Although the reservoirs and the pressure regimes are different, we've used our development planning knowledge to normalize and deliver very similar economics. The combined effect of a well-thought-out development plan at Attachie, strong well performance, efficient operations, and taking the learnings from all of our other operations and assets across Northeast BC and into Caqua allows us to deliver very strong free funds flow for shareholders. Investing in Attachie will deliver $500 million of netback of annual funds flow in 2025 go forward, which will be sustained for a decade plus due to that very strong inventory. And this is due to a combination, of course, of having both gas and high-value condensate production. So overall, between Armin and I, we did not speak to all of ARC's assets in detail. We do have two other core assets in ARC's portfolio, those being Parkland, which is part of the Greater Dawson area, and Ante Creek in Alberta. Each of these play an important role in our portfolio. We think of each of our assets as being a standalone business that needs to deliver free funds flow back to the corporation. And each asset is doing exactly that, with the inventory to sustain that free funds flow for the next 10 to 20 years. We're going to continue to focus on profitability as our core mandate. And what that really means for the development operations teams is focusing in on capital efficiency. We've taken big steps, as we've shown you today, on improving that capital efficiency, and we're going to continue to focus on that go forward. With that, I'd like to hand over to Ryan to provide an overview of our marketing and LNG strategy.
Good job. Thanks, Lara. Good afternoon, everybody. Great to see everybody. I'm really excited today to talk about our marketing strategy. And, over the past years, thinking back on it, as our company has grown, our marketing strategy has evolved. And really pleased to say, it's allowed us the opportunity to create more value for every barrel we produce. So we'll dig into it here. First off, starting with our marketing strategy. This has been in place for the last decade, and it's really about three different components. It's a multi-pronged strategy to make sure that we get the best price for the barrels that we produce. The first component is market access, paramount to everything we do. Obviously, we need to ensure we can move our current and our future production. Egress in Canada remains extremely challenged, and it's something that we are always looking around corners to make sure that we can move our product. We have very strong ties with Lara's development team and our long-term plan. For natural gas specifically, we need to be ahead of the market by about 6 to 8 years to ensure that we can secure takeaway. I'm pleased to say that we have takeaway secured on the gas side till the end of the decade, and on the liquid side for future development phases of Attachie. So very, very strong. We also try to move our product on dual connected pipelines through our dual connected facilities. So, we want to, where possible, make sure we have no risk of operational upsets. From the market diversification side, the diversification of markets for us really first and foremost reduces volatility. Obviously, we want to move our production into consuming regions at the lowest cost, and that's paramount to our strategy. And as we grow, we're driving hard to ensure that we remain diversified within our portfolio. And this isn't just natural gas, this is across all of our products. Lastly, it's around price optimization. It's around being nimble, utilizing the assets that we control both pipeline and the ownership of our infrastructure to create the most margin for our barrels. With that, I want to play a video that describes our overall marketing strategy and hopefully provide some insight into how we move our product.
ARC Resources is a global leader in responsible energy development. As the largest condensate producer and the third largest natural gas producer in Canada, ARC produces roughly 350,000 barrels of oil equivalent per day. Approximately 60%, or 1.3 billion cubic feet of this average daily production is natural gas, while approximately 40%, or 140,000 barrels per day, is crude oil and liquids. Our goal is to connect this low emissions energy to key consuming end markets at the lowest possible cost. And our diversified transportation portfolio helps us achieve this goal while capturing more value for every molecule we produce. For our natural gas, ARC has connectivity to several key consuming regions in North America, including right here in Western Canada. We have contracted capacity to Malin in the Pacific Northwest, Chicago in the Midwest, Dawn in Southern Ontario, and Henry Hub on the Gulf Coast. This diversification provides optionality that allows us to better manage risk. It also allows us to participate in the global LNG market, where demand is expected to double by 2040. To date, we have announced 3 LNG agreements. On the U.S. Gulf Coast, ARC will supply approximately 140 million cubic feet per day of natural gas to Cheniere's Corpus Christi Stage 3 facility. From here, it will be liquefied and exported to key markets in Asia, where it will be used to meet domestic energy demand. Then, on Canada's west coast, ARC has announced 2 agreements. The first with an LNG Canada participant, where ARC will supply approximately 150 million cubic feet per day of natural gas. And with Cedar LNG, where we've signed a memorandum of understanding to supply 200 million cubic feet per day. These agreements provide access to premium markets, both domestically and internationally. Ultimately, Canadian LNG will provide energy security, displace more carbon-intense energy sources, and lower global emissions. In all, ARC's market access, scale, investment-grade credit rating, and leading ESG performance have supported our participation in the global LNG market. In addition to natural gas, approximately 40%, or 140,000 barrels per day of ARC's production is crude oil and liquids, most of which is condensate. This condensate is primarily destined for Canada's oil sands to be used as a diluent in the transportation of bitumen. ARC has contracted long-term capacity on 2 major pipeline systems to move our liquids production to Fort Saskatchewan, near Edmonton. From there, it is transported to oil sands producers near Fort McMurray and Cold Lake. Demand for condensate is expected to remain strong due to a shortage of supply in Western Canada. Through our confirmed transportation commitments in the area, we are well positioned to help meet strong demand for this high-valued product. To learn more about our marketing strategy, visit our website at www.arcresources.com.
So I hope that video is helpful, giving an overview of how we move our product and the complexity of moving our product throughout North America. We have a dedicated team and very high integration with all of our field operations to ensure that we are able to keep production flowing every day, especially as we get bigger. Moving into condensate, and it's interesting, we spend a lot of time talking about gas, but condensate is actually the biggest revenue driver of our organization. As Terry mentioned, we are the largest producer of condensate in Western Canada. We produce roughly 75,000 barrels a day within Western Canada. All of our condensate is separated at our own facilities and moved down 2 separate pipelines into the Edmonton area, where we sell our condensate into 2 different liquid hubs. We have direct long-term sales agreements with the major oil sands producers, and we're very constructive condensate prices going forward as we see oil sands production continuing to increase and the need for diluent therefore continuing to increase, as well as the import pipelines that are required to balance the market remain full. Currently, we're short about 250,000 barrels a day in Canada of condensate, and it's the only product we produce that we are short in Canada. So very strong from that perspective. Into our natural gas strategy, again, we have a very diversified portfolio, as we've talked a lot, and this portfolio allows us to manage risk and participate in market dislocations. As I mentioned, egress remains constrained out of Western Canada, and we're very happy with the portfolio we have in place today. We have long-term contracts into all of these markets with renewal rights, and this will be a staple of our diversification going forward. We've built this up over a decade, and as Terry talked about, to get into the market now at the cost structure we have it cannot be replicated. So it's something we continue to drive forward and look for additional opportunities. We also supplement our physical diversification with financial diversification. And you can see the light blue wedge on the chart in 2023 and 2024, where we have financial instruments in place to help protect us against price risk and dislocation risk. Again, this is paramount to our strategy. We have a very strong fundamentals team internally, and we're always looking at where do we want to best position our gas prices. And as we look out forward, again, Canada remains very constrained. LNG Canada coming on in the middle of the decade is a great demand pull, but we still need export pipelines to move production to market. In the US side, we see very strong demand, primarily as a result of LNG growth out of the Gulf Coast. And we'll get into that and how we think this is an advantage that is great for North America, great for the world, but also great for us with the positions that we have. So this portfolio approach has allowed us to participate, as I said, in market dislocations. We consistently outperform peers, and it's served us well, especially over the past decade in periods of low pricing. Over the past decade, ARC has received an average gas price that's 20% above the AECO index price. So just to illustrate and show how advantageous this has been for our business. As we think about global LNG and the globalization of gas, this really presents an opportunity for further portfolio diversification. We view LNG as just a complementary extension to our market diversification business. It's moving further downstream, but we're still moving markets into consuming regions. We feel this is going to be fueled by North American supply, and the proximity to our pipelines to the liquefaction facilities really allows us the ability to move our production into the LNG market. We see demand for LNG increasing almost double over the next 20 years. And so again, this is fueled by Asia, but also static demand from Europe that continues to be in place. So to summarize where we are at on the LNG side, we bring the strengths that we bring that can't be replicated by our peers, include our size, our scale, our investment grade credit rating. I think the link to our asset base and the amount of inventory we have allows us to sign these 15 to 20-year contracts, as well as our investment grade credit rating. And this, as part of the business combination with 7Gen, this was a strategic driver to allow us to enter into these long-term deals. So to date, we've entered into 3 long-term gas supply deals. Again, we're trying to make sure that we're creating market for the production that we're producing. The first deal that we signed a couple of years ago was with LNG Canada. This was really a strategic entry point into having our Sunrise asset directly connected into the Coastal GasLink pipeline. We're the only non-equity partner to have our facilities directly connected into Coastal GasLink. This deal is a long-term premium to AECO, so it is a Western Canadian-based price with a premium. But again, the drivers of that were the connectivity into that pipeline. The second deal we announced a year ago is with Cheniere. We're really pleased with this deal. This is the first internationally priced deal that ARC has done with a great counterparty that has very similar values to the values that ARC provides. This is a JKM and Asia netback deal where we have fixed liquefaction, fixed shipping for the term of the contract. And the beauty that Cheniere brings to this is they provide all the operational expertise. And so we are not at risk for any logistical things that can happen in a value chain that's moving gas across the world. Recently, we've just announced a partnership with Cedar LNG, an MOU. That was back in March. And this is a really exciting project for Canada. This utilizes the Coastal GasLink pipeline, and it's the first Indigenous-owned LNG facility in Western Canada. It's a 50-50 partnership between Pembina and the Haisla First Nation. We're in the early phases of commercial negotiations on this, but very excited to move forward, and this project would likely come on in 2028 or 2029. Lastly, we are actively working on securing another Gulf Coast transaction, and you can see on the map, we do have capacity that is very difficult to get into the Gulf Coast, and we are looking to solidify another LNG deal by the end of the year. These deals, once fully executed, will meet our target of up to 25% of our future production being moved into international markets. And most importantly, as we focus on the financial implications, as it is with all of our business, our cost structure is so important. We've spent a lot of time looking at all the various liquefaction facilities across North America, and we're making sure that we can liquefy and ship our gas for the lowest cost. We can land our gas from Western Canada into Asia for about $5 to $6 US per M. And assuming a $3 AECO price, that would make our break-evens about $8. The chart on the left shows, or the chart below here shows the torque, the significant torque to our business. And obviously we look at the upside, but we're also making sure we can manage the downside. And the way these contracts are structured, we're very happy with the exposures. So we're very excited to build into this new venture for our business, and very happy to pleased to share it with everybody. I guess one very important point as we look to our business into the future is the ESG characteristics. And as we've spent time in Europe and Asia, this is really starting to become on the forefront of everybody's minds. And with that, we have a great story to tell, and I'll pass it off to Armin.
Thanks, Ryan. So as Ryan mentioned, our ARC's low emissions production is an important part of our LNG story. So I want to spend a few minutes to present our environmental performance. The most recent data from 2021 shows that ARC continues to deliver top decile performance in terms of both greenhouse gas emissions as well as methane intensity. The data on this slide includes both the Scope 1 and Scope 2 emissions, which for ARC includes emissions from our own and operated infrastructure. It is important to highlight that because in comparison, some of our peers that we show on this slide report lower emissions as they benefit from processing their gas through third-party facilities. Over the last few years, we've been able to demonstrate our ability to reduce ARC's emission in a significant and meaningful way. In Northeast BC, our journey started in 2011 when we electrified our first Dawson plant. Since then, we have electrified all our facilities in Northeast BC, and Dawson 3 and 4 plant is the last plant that we just finished electrifying about a couple of weeks ago. The electrification of Northeast BC asset has resulted in about 22% reduction in our absolute emissions in BC since 2017. And it is important to note that in the same period of time, we've increased our production by 57%. We believe with rising carbon tax, this work will help us in continuing to deliver low-cost production in Northeast BC. We also strongly believe in technology and the role it plays in reducing our sector's emission in coming years. To support this vision, ARC has committed to investing $50 million in clean technologies. These investments will not only give us the opportunity to evaluate some of these innovations, but will also give us the chance to use them at ARC facilities to further reduce our emissions. To date, we have invested about $40 million of that budget, which has provided us an exposure to a whole suite of technologies, from detection and monitoring to various carbon capture technologies, as well as investment in a hydrogen technology that has the potential to reduce our facilities emission in future. With that, I pass it over to Terry for his final comments.
Well, apparently we all have favorite slides here. Maybe this is your favorite slide, because it's a good slide. We've gave you a lot of information here today, so I want to summarize from my perspective what the top takeaways are. So, world-class assets. There is no question we have world-class assets. We have a balanced commodity mix with being the largest condensate producer. That's a strategic advantage for ARC. The Caqua inventory, we have at least 15 years of keeping Caqua production flat at 180,000 BOE a day. Attachie liquids-rich development, well, that property can rival the production of Caqua to 180,000 BOE a day. That's big. And our unmatched high-quality assets have the capability to produce and sustain production up to 500,000 BOE a day for decades. We're committed to shareholder returns. We have shown that this approach to capital allocation will be balanced in the 5 years. So we're going to invest in Attachie and grow that free cash flow. We're going to buy back shares when they're attractive. We're going to increase the dividend on an annual basis. There's a lot of free cash flow coming back to shareholders today and more tomorrow. And we have a margin expansion advantage. You heard Ryan talk about the LNG. The scale of our business combined with the decades of that high quality inventory allows ARC to pursue these global diversification and margin expansion opportunities. This is an important differentiator because not many of our peers can actually do this. It's different for us. We're big enough. We have the resource. We have the capability to actually grab those margins. So that's different. And I'd say to close on, this is probably the most important takeaway, is that we have the right people and the high performance culture to deliver on this 5-year plan. And that's the most important piece, is the culture and the people. So to close, I have a few thoughts. When I reflect on my talk about the LNG, the scale of our business.
So a couple of thoughts here to share with the viewers as Terry here concludes his presentation. So obviously this quarter they produced 343,000 or so, just over that BOEs per day. In Canadian dollars, we saw that the enterprise value was 12.6 billion in market cap, plus about 1.26 billion in Canadian dollars in debt, and overall enterprise value was 13.8 or so billion, and so they're producing 343,630 or so this quarter. And obviously, based on this presentation that we just seen, really impressive comments by the leadership team. And obviously, this is a growth story. We got some explanation to some of the numbers. The jump in production was associated with the 7 generations acquisition that took place, which was transformational for this company. And obviously, they're focused on the Caqua growth expansion with 15 years of inventory, sustaining production at 180,000 BOEs per day. Focusing on kind of liquid rich, which is like the condensate kind of stuff, and really capability to grow to about 500,000 BOEs per day. So this is really interesting story, because in a way it's kind of one of those growth stories, and yet they're talking about returning value to shareholders in the form of dividends and buybacks. And so here they're basically saying 10% annual increase in dividends, and Terry had mentioned that buying back shares when there are, when it's a good time to buy, I guess, when it's cheap, I assume, I don't know, and a 5-year plan to double the free funds flow per share. Now, another important comment to mention, like last year in 6 months, through that, when Russia attacked Ukraine, they were able to generate just over $1 billion in free funds flow in just 6 months. So in a very high oil environment, those guys can do quite well, but one must be mindful of the fact that they're they have in those growth plans. And and you can see it on the decline curve how basically they kind of, to maintain sustained production, they have to drill more wells and kind of sustain those as the production kind of decays over the course of, let's say, 12 months or so. So let's kind of finish hearing Terry's final thoughts. In this live, you guys learned a little bit about, well, I think it was a lot actually, learn about ARC Resources. We went over their Q2 2023 results. You saw the cash flow, you saw the revenues, the income, the oil production. We partitioned the oil production rates, really trying to understand them. We learned that this company produces 63% gas and about 37%, I would say, a kind of oleic phase composition. But again, there's a lot of kind of mixing in there. And you saw there are significant marketing capabilities and opportunities to provide their products to markets. So on that note, let's hear what Terry has to say as we conclude here. And thank you again for watching this live, and all the best. But we'll finish here in 2 minutes as Terry concludes his remarks.
Business combined with the decades of that high quality inventory allows ARC to pursue these global diversification and margin expansion opportunities. This is an important differentiator because not many of our peers can actually do this. It's different for us. We're big enough. We have the resource. We have the capability to actually grab those margins. So that's different. And I'd say to close on, this is probably the most important takeaway, is that we have the right people and the high performance culture to deliver on this 5-year plan. And that's the most important piece, is the culture and the people. So to close, I have a few thoughts. When I reflect on my 23 years at ARC, I am very proud of how we've built this company to be one of Canada's largest and most respected energy producers. Now with our increased scale, we can do more. We are expanding our reach to be a global leader in delivering responsible energy to the world at a time when the world needs more responsible energy. That makes me proud that our company of 28 years can help create a better world for everyone. So that concludes our formal presentation. I want to thank everybody online for attending, and we'll say goodbye to them.
Goodbye. All the best. Thank you for watching. Like, subscribe, and share with others. Thank you so much. And thank you to the ARC Resources team for providing this update for investors in June. And as you saw today, quarterly results were provided for Q2 2023 and the upcoming plans. Thanks, guys.